And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to the show. Of course, it's Tuesday, and interesting day yesterday. Markets had a nice rally. We'll get into that this morning. What that means, of course, we talked about this a bit yesterday. We published our Tuesday take on Monday, so yesterday we kind of went through that article because it kind of laid out the pathways for this market rally that we're kind of expecting. So we'll kind of go through that this morning here in just a minute. But outside of that, very interesting, there's been this kind of rush to judgment, so to speak, by economists who are now very certain that there is going to be no recession in the economy at all, period. However, if you take a look at some of the economic data, it's starting to suggest that lag effect that we had talked about previously is now starting to play a bit of catch up. If you take a look at unemployment, right? Unemployment is starting to rise. And again, that's kind of the first indication that you're starting to see a weaker economic environment. Full-time employment relative to the population has been declining rather sharply as of late. That's another one of those indicators that you kind of look at and say, yeah, that's not what you want to see if you're going to have this strong economic growth. And the reason I bring this up is that if you take a look at consumer spending, loan demand by consumers has been dropping sharply. So consumers are not taking out loans to buy things with, right? So that's going to lead to slower economic growth. Bank lending standards have been easing, right, to try to get more loan activity, but loan activity is still declining. So we're kind of seeing that kind of point to where the excess savings has now pretty much resolved itself from back in 2020, 2021, right? All those checks that we had coming out. At the same time, you're seeing the monetary supply, and we talked about this before, is that if you take a look at monetary supply, often people refer to that as M2, that was very, very elevated. So we dumped all this money into the economy, right? So we did checks to households and government spending bills and all kinds of stuff. So we had this massive increase in M2. And we talked about this previously, talking about this pig and the python, right? And so there was all this capital that had to work its way through the economy, and that was lengthening that lag effect on economic activity. It was keeping economic activity. There was so much money floating around, it just kept economic activity going longer than people expected. So economists were expecting this recession in 2022, didn't happen. So in 2023, they go, well, maybe we're not going to have a recession. 2024 is like, yeah, definitely not going to have a recession. But that excess money supply is now returned back to normal. So that's come out of the system. Now, there's still some lingering effects of that, and we still continue to see economic activity kind of percolating along right now, but we're starting to see the early signs of evidence. Job openings been declining, right? So all of a sudden, employers who were, hiring left and right, because why do I hire people? I have a lot of demand. When I have a lot of demand, I have to hire more people, put them to work. That's good, right? That's a sign of economic growth. If I don't have economic demand, right, I don't have customers coming into my business, then I'm going to hire less people, right? I don't have really enough demand to warrant hiring more people. So job openings start to decline. Early indicator. Right, so we've got an early indicator of job openings declining. We've got an early indicator of unemployment, the unemployment rate starting to rise here. We're up to about 3.9. Again, not alarming yet. You don't go out, this isn't, I'm going to run out and, buckle down for the recession, because I'm not saying that. But all these, economists that are absolutely certain right now that we're not going to have a recession, there is some data that is starting to kind of wake up here. Again, we're still having inverted yield curves, longest span of yield curves on record so far. So again, there's that economic data that is just worth paying attention to. Certainly suggests the economy is slowing down. That's going to be, that's going to bring down inflation, right? And so this is why the Fed will start cutting rates. If this data is right and it continues to slow down, then that's going to lead to slower economic growth. That's going to lead to lower rates of inflation. The Fed will have to cut rates, right? So that's worth paying attention to. And again, it's not anything that says recession tomorrow. Doesn't say recession in a month from now. But over the next year or so, this is the kind of data you want to be looking at. And if these trends continue, right? Now, if they just pick up a little bit, then go right back down, no big deal, right? No recession. But if they continue to kind of mount, if we continue to see that slowdown in economic activity, we continue to see that slowdown in buying power by consumers, you're going to have an economic slowdown, aka/recession. So just pay attention to that. Now, in the short term, doesn't mean a thing, right? So in the short term, as we talked about yesterday, we laid out these kind of three pathways for the markets. We said one was the market breaks above the 50-day. The second one was a failure at the 50-day, retest the 100-day. Third one is a failure of the 100-day, retest the 200-day. So we said the most likely probability was going to be a rally that took us above that 50-day moving average. That's what happened yesterday. And we saw this nice advance. Market broke above that 50-day moving average. That triggered the buy programs from computers, right? So all Wall Street computers went, 50-day, got to buy it. And so we had a very nice rally all day long and then a little spurt of buying right at the end of the day, closed at the highs for the day, so very bullish. Now, markets are now back to overbought. Now, we're on the SPY signal, so again, no real near-term concern about a bigger decline at the moment. We are back to overbought. So what I would expect here is maybe a little bit of sloppiness here over the next few days. What would be great is for this market to retest the 50-day moving average, hold that. So now previous resistance now becomes support. So we come back down over the next day or two, test this 50-day moving average, and then potentially make another move higher over the next few days. That would be the most bullish outcome here. That would kind of confirm that pathway that we talked about to retest these previous highs back from March. Now, 5,200, 5,300 is probably the top of this rally. Wherever we're going to do, there's probably not a lot here to go. It could be, right? But again, we've already had a pretty decent return for the year so far. We're about to head into the summer months, pre-election. And as we talked about yesterday, we could certainly have a situation where we have another decline in September, October before the election. So again, volatility-wise, we're certainly not out of the woods. But yesterday's action certainly confirmed that this correction that we had is now over. So we've now completed that corrective process. It was a 5.5% decline from the peak. So again, it did its job of what we needed to do. It worked off some of that overbought condition. A couple other things here. We're starting to see a rotation back in the markets. So we had a rotation from the mega cap 7, right? The Magnificent 7. They were leading the market early this year, all about AI. That rotated, Apple underperforming, Google underperforming, Nvidia underperforming during this kind of latter stage here and during this decline. Those underperformed, and we saw a rotation to basically utilities, real estate, other areas doing a lot better. Now we're seeing that rotation back to that Magnificent 7. So that is another kind of confirmation that this corrective process is now complete, and we're going to now resume this bullish trend that we've been in. Now, again, not probably at the same advance rate that we had from last November, but we're more likely to have more up days here over the next few days than down days. So again, nothing, again, this whole corrective process was nothing really to be overly concerned about. It was nothing more, it was difficult to hedge at best other than just taking profits. And now we use this kind of decline here to add to positions we wanted to add to. We talked about using that as an opportunity. So now we're in a good position here for whatever this market does next. But again, market looks to be a little bit weak this morning. We'll see what happens. A little bit of weakness over the next few days, not surprising because we're overbought. Okay, quick break. We're going to come back. That's what you need to know before the bell this morning, by the way. So, and when we come back from the break, we will get into some more of the data on the markets and the economy. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
So you're ready to retire, but are you ready to transition to Medicare? Knowing how health insurance works after you leave your job is vital. Our next Lunch and Learn will tackle transitioning to Medicare, Wednesday, May 15th, with Danny Ratliff and Richard Rosso. How do you sign up for Medicare? And how will it work with the insurance you already have? Food for thought and food for your belly. Register now for our Transitioning to Medicare Lunch and Learn with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the show this morning. So just kind of talking a little bit about, some of these economic indicators. Now, again, I want you to be real careful with this because, I'm not saying that we're about to have a recession tomorrow. So don't go jump off that cliff. Right now, everything is fine. But what I was saying is that some of this economic data, like unemployment, is beginning to show signs of slowing down, right? Not in a big way, right? Jobless claims are still very low, but there's some issues with jobless claims. But the unemployment rate and what's going on in some of the other employment indicators like job openings, et cetera, are all certainly showing some signs of weakening. Those now, that could just be an economic slowdown, nothing more than that. Or it could be something more. Right? We still have this lag effect. We still have high rates, across the board. People are running out of money. We're seeing that, as I was saying. Now, again, this is the challenge. When everybody expects that we're not going to have a recession, that's normally when you can have a recession. Remember back in 2022, we had it seems like so long ago now, in 2022, it was like everybody was expecting a recession. I mean, the expectations of a recession were 100%. Now, nobody expects a recession. And as we said back in 2022, when everybody expects something to happen, something else generally tends to occur, and that's the way it turned out, right? We didn't have a recession. In fact, everything was fine. Now, literally no one, expects a recession, which kind of sets the economy up to have a recession, right? Because you need that shock effect for things to happen. You need that event to occur where everybody says, I'm done spending. I gotta hunker down. Again, that can take a while. So again, don't go out today and start making any adjustments to your lifestyle today. But just understand that we're starting to see some of that data now starting to show up. And again, this doesn't mean you have to have a recession. It does mean slower economic growth, which as economic growth slows, that's going to bring your demand side of the equation down. Supplies increase because companies tend to slow to respond initially. So you get this increase in supply, drop in demand, and then companies have to liquidate inventories at discounted prices, and that's where you get deflation. Or disinflation, I should say. Not deflation, but disinflation. So again, that's kind of the dynamic that we're playing with here short term. We'll see, how this kind of works out. But, as we did talk about yesterday, there's not a lot of risk yet in the credit markets. And that's the one thing that you really, really want to pay attention to. Because if there is going to be, and again, if you're an investor in the markets, set everything else aside. If you're watching videos of people, declaring the end of the world, etc., that's fine, right? It's great cannon fodder. It is, really, really bearish outlooks, kind of that end of the world type stuff is like, oh, this commercial real estate is going to be the next financial crisis. Maybe, right? Maybe. But if there was going to be a crisis, it will show up in the credit market because the credit markets are the lifeblood of the economy. The credit markets are about 4 times the size of the stock market. So really don't pay a whole lot of attention to what the stock market is doing. Pay attention to the credit market. If you're investing in the markets, the credit market really tells you all you need to know about whether or not you should be concerned about an economic event. So when these people are out rambling about, oh, the yen's crashing, that's a surefire sign that this is going to happen in the economy and it's going to be terrible, or, this is happening. We've had and here's a really good thing, also too, is that every time, a geopolitical conflict breaks out somewhere, Israel, Russia, Ukraine, everybody goes off the rail. This is going to be World War III, and this is the beginning of the end, and those type of things. Geopolitical regional conflicts do not matter to markets for long, right? Basically you buy the room. What you do is you sell the first bullet that gets fired. And then you buy immediately after that. Because these geopolitical conflicts do not affect global markets for very long. Just that initial first bullet, everybody's going to kind of retrench for the moment. But as soon as you realize this is not spreading into world war, buy it. Because they don't last long. What does impact global markets is world wars. So if we do have an outbreak of a world war, you don't want to be in the markets. You don't want to be much in anything at that point. So all these kind of end of the world doom and gloom stuff, it's going to show up in the credit markets. And we talked a little bit about that yesterday. We looked at the spreads between triple C and AAA bonds yesterday. And again, there's really no stress there whatsoever. Right now, the spread between triple B bonds and treasuries, so basically corporates versus treasuries, is at the lowest on record. Right now, you are not paid for the risk you are taking buying investment grade bonds. You might as well just buy treasuries and have the guarantee from the government they'll repay the debt versus the potential default risk of corporate bonds because you're just not getting paid for it. That spreads down to 90 basis points. So that just shows you that there is no real concern or stress within the financial markets or the economy right now. If there was stress in the economy of any degree, the spreads between corporate investment grade bonds and treasuries would be widening because the corporate bond market would be going, hey, there's some risk on the horizon here that I see, and if I'm going to loan you money, so you're ABC company, right? So I'm going to loan you some money for the next 10 years. But I'm seeing a slowdown in the economic data. I'm seeing a potential risk here on the horizon. I'm going to have to charge you a higher rate because I need to hedge off that risk of loaning you money for 10 years where I don't get an opportunity. I can't come back in a year and change that rate, right? We're going to lock in a rate for 10 years. So that rate has to include my best calculations for economic growth, opportunity risk, inflation, all that type of thing. And there is no spread right now. So nobody is expecting stagflation, higher inflation, anything else, because otherwise the spread would be higher. And it's not. So pay attention to credit risk and particularly credit spread. So, you can look at all different kinds of spreads in the credit markets, triple C to triple A, triple C, triple B, triple B, triple A. All over the place. Double B, double A. And none of them are showing you any type of duress in the markets at the moment. But that's what I'm saying, is that's what you want to pay attention to. So, when people come out and they're starting to have these really, really bearish headlines, just take a step back and go, okay, I hear what you're saying, right? Go look at credit spreads. Are credit spreads confirming what they're saying? If the credit spreads aren't confirming it, it's not an issue. And as is always the case, right? When you hear these really negative headlines about this or that or the other thing is going to be the disaster, it's not. And here's why. If that person knows about it, so does Wall Street. And it's already factored in. Again, and again, this is just the best example of what I'm trying to talk about. And it was forever ago. But we're coming up on the 20-year anniversary of the financial crisis in a couple more years. That's hard to believe, right? It seems like just yesterday. It's how old we're getting now. But back during 2008 and early 2008, yes, we had subprime loans out the wazoo, right? But everything was holding in there. Everything was okay. Yes, things were getting repriced. Market was declining. We were down about 15% from the peak. It wasn't a disaster. It was kind of a very orderly unwind of a lot of excess in the markets getting into 2008. So in June, July, August, the market put in a topping pattern. We violated that topping pattern. The market starts to decline. Again, very orderly. And again, just kind of a normal start to a bear market. Nothing egregious, right? Subprime was contained, according to Ben Bernanke. There was certainly some stress in the credit markets that were telling us something was going wrong. But nothing fell apart until that unexpected event in September when they bankrupted Lehman, and then basically nobody trusted to trade with anybody, right? It just closed all the counterparty trading at that point. Nobody expected that. The bulk of the decline in 2008 occurred after that point. So whenever you hear these headlines about some event is going to be the unwinding of America, whatever it is, Wall Street already knows about it. The thing that gets the market, the thing that causes that unwinding of the markets is something that nobody ever expects. It has to be, by its very nature, an unexpected exogenous event that takes the market by surprise. All right, quick break, come back. More of the show coming up.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
So you're ready to retire, but are you ready to transition to Medicare? Knowing how health insurance works after you leave your job is vital. Our next Lunch and Learn will tackle transitioning to Medicare. Wednesday, May 15th, with Danny Ratliff and Richard Rosso. How do you sign up for Medicare? And how will it work with the insurance you already have? Food for thought and food for your your belly. Register now for our Transitioning to Medicare Lunch and Learn with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Gen Zs are now rediscovering old stuff.
Yeah.
Camcorders and flip phones. See, I think Apple's missing it. They need to come out with a flip phone.
That would be brilliant.
Yeah, when you flip open the phone, it plays 90s music. They're rediscovering 90s music.
The Real Investment Show podcast. Same show, your schedule.
They're not discovering good music, right? They need to go back 10 more years, get to the 80s.
At realinvestmentadvice.com.
Get to some good music.
70s.
No, not the 70s, Brent. 80s.
I'm with you, Brent.
60s.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
You know, there's a couple of things you don't like getting in the mail. Bills, right? Those are never fun, right? Nothing good comes in the mail. It's either bills or junk mail, right? You know, long gone are the days that, you know, somebody hand wrote a letter to you to see how you were doing, right? So it's either bills or, you know, junk mail or something from the IRS. So you get this letter and you always know when it comes from the IRS because it's the big envelope, right? It's the 8.5 by 11 envelope. It's not the little letter size. Barry Tanger of Mount Joy, Lancaster County, got the shock of his life after filing his taxes this year. The Pennsylvania Department of Revenue sent him a tax bill for more than $34 billion. To be exact, it was $34,576,826,561.47. Now, he makes about $100,000 a year, so there's no obvious error, right? But can you imagine that? You get a bill from the IRS, you owe $34 billion? That just kind of ruins your whole day. So, just stuff that happens in the world. So, one thing that's, you know, since it is that time of the year, right, it's tax season, and we're talking a lot about, you know, government spending, and of course that requires revenue, of course. And, you know, one of the things that Joe Biden is talking about in his presidential election campaign, and I find that this is always a very interesting thing for me. The rich need to pay their fair share. And it's a very common misnomer. AOC was caught wearing the dress at the gala she went to. It said tax the rich. And so it's always an easy kind of spot to go after the rich, right? We need more tax revenue. Let's go get it from the rich people. The question is what determines the fair share, right? Warren Buffett just sold 13% of his Apple stake. So he'll pay a 21% tax on several $billion of income from that capital gain. And he's okay with that, right? Rather pay it now at 21 than later at 35. Makes sense. But, we talk about this issue as if, the rich are this unlimited bucket of money that we can just go tax. And we do this in kind of this idea that, we want to spend more money, so let's just go tax people more, and, it'll be great. And I'm pretty sure somewhere along the way, we fought a war over this whole taxation thing, right? If you take a look at what you pay in taxes, it's not just income tax, right? It's sales tax, gas tax, this tax, that, probably 60 to 70% of your income goes out to taxes in some shape, form, or fashion. But it's always an easy thing, right? Let's just, because since most of the people in this country aren't rich, it's just easy. Oh yeah, let's go get the rich people and have them pay all the taxes. But the question comes down to, what is a fair share? Now, what Joe Biden's talking about for his next presidential term is, taxing capital gains, unrealized capital gains. So in other words, Warren Buffett owns Apple stock, and he's got $1 billion gain in it that he hasn't sold yet. It's just gone up in value. He'll owe tax on that, even though he hasn't sold it. So now unrealized capital gains would be taxed. That has severe implications for the average everyday American who has a few shekels put away in their 401k plan. But he also wants to raise the income tax just on the rich themselves, right? So all kinds of numbers getting thrown out there, 44% tax rate, et cetera. And the reason that we want to raise this tax rate is so we can spend more money, right? That's just obvious. We need to tax people more so we can spend more money doing all the stupid stuff that we do in government that's not really even our job. Government has two jobs, right? Infrastructure and national defense. That's it. Everything else belongs to the states. Education, energy, EPA, all that should be in the states, right? If the state wants to regulate their economy, their ecology, whatever it is, that's their business. Government has two jobs: national defense and infrastructure, making sure we have roads and bridges and electric grid and those type of things. And if the government spent on those things, right, we would have what we call productive investment in government spending. And we wouldn't have a tax problem. But government has gone so far beyond that now. We have to support everybody, from illegal immigrants to widows and orphans and, other countries we send billions of dollars of foreign aid to that do nothing for us anyway. So we have to spend more money, right? All in the name of causes, whatever those causes are. So we have to get that money from somewhere. So we can either issue more debt or we raise taxes. So the question is what's a fair share? So interesting, Miss Shedlock, a friend of mine, had a very interesting article out this past week talking about this very issue. And he had this great chart. It's the share of total income taxes paid. So the top 1% of the economy pay 45.8%. The top 5% pay 65%. So that includes the 1%. So the next 4 pay a total of 65%. So basically 2/3 of all taxes are paid by 5% of the economy. Go to the top 10. Right, so you have the next 5%, they're at 75%. The top 25 pay 90%-ish, right? Top 25 to top 50, 97% of all taxes paid by the top 50% of income earners. The bottom 50% pay 2.3%. Now the question is okay, great. Let's tax the rich more. So let's just keep it focused on the top 10, right? The top 10%. Those are the rich people. Well, they already pay 75% of the taxes, so should they just pay all the taxes? I mean, would that be the fair share if we just collected 100? I tell you what, let's go one step further than that. Why don't we just charge them 100% tax on everything they make? Why don't we just take all their money from them? And see, that would solve our problem for about a minute. Because even if you took all of their wealth, it wouldn't put a dent in the debt that we owe. But this is the problem with these narratives. See, people never know the numbers that you're looking at. It's just like, oh yeah, because we hear stories, right? That, Amazon paid no taxes on their income this year or that year, whatever it was, right? And so yeah, we obviously need to have them, pay more. And that's that. But again, the question becomes, what is a fair share? So if we put it in dollar terms, this is a little bit better way to look at it, right? So percentages are a little bit kind of strange. But if you take a look at the average income taxes paid, the top 1% pay on average about $653,000 in taxes. The top 5% pay $187,000 in taxes. Top 10% pay $108,000. Bottom 50% pay $667. Actually, and I'm going to switch charts on you here, Brent. If you actually take a look at the income taxes that are ultimately paid and what they actually pay in millions, you can kind of see that a big chunk of the $1 trillion of taxes that get paid. We have $1 trillion of taxes that get paid by the top 1%. The top 50 pay $2 trillion. The bottom 50% pay about 51 million or 51 billion. Sorry. So again, what is the fair share? And look, I don't have the answer for you, right? I don't think there's a magical number, but I think the point that we're making here is that the lion's share of all the taxes are paid by the top 10% of income earners already. And here's the problem with this idea that they need to pay their fair share. The problem is that their wealth is portable. I can take my wealth and go to another country that's more tax friendly. This is why a lot of people are getting citizenships in countries like New Zealand, right? They can leave the country. You can't, right? Most of us can't. Most of us can't just pick up and go to another country and try to find a job and all those type of things. They don't need that, right? They own businesses. They have plenty of wealth. They can export, their business. They can move their headquarters overseas, and they already do their manufacturing offshore because it's stupid, ridiculous to try to hire people in the U.S. to do work because, all of our workers are entitled. So it's easy for them to be portable. And so the problem is that if you keep attacking the wealthy, which are already paying a very significant chunk of all the taxes, they'll leave and not pay any taxes. So now what have you accomplished? But the story here, though, is that these narratives are great, right? Because most people don't know the numbers. Like, tax the rich. Yes, let's go after those rich people. My life sucks. I don't have any money. But there's a consequence for that. And the real message should be not, when they say, let's go tax the rich, our message should be, hey, why don't you spend less? Go back to doing what you were supposed to do. National defense, infrastructure, turn the rest over to the states, cut government a lot, and we don't have to tax the rich more. In fact, we could tax people a whole lot less. All right, quick break, come back, wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
So you're ready to retire, but are you ready to transition to Medicare? Knowing how health insurance works after you leave your job is vital. Our next Lunch and Learn will tackle transitioning to Medicare, Wednesday, May 15th, with Danny Ratliff and Richard Rosso. How do you sign up for Medicare? And how will it work with the insurance you already have? Food for thought and food for your belly. Register now for our Transitioning to Medicare Lunch and Learn with Ratliff and Rosso at realinvestmentadvice.com. realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
You know, things are getting kind of out of hand when you start reaching the point of being ridiculous. And, you know, one of the things with, you know, in a lot of other countries around the world, like the UK, so my son lives in the UK, my wife's leaving on Sunday to go visit with him. And of course, in the UK, you can't own a gun, right? So gun ownership is prohibited. And so, you know, we talk a lot about gun laws here in the U.S. and that we need to ban guns, et cetera, because that'll solve our crime rate. If we just get rid of the guns, we wouldn't have any crime, right? That's the thesis. But in the UK, they're having a massive epidemic in knife crimes, right? So if you take away guns, people will just resort to some other measure and use knives. And not just UK, it's all over Europe. Different places in Italy, North African migrants armed with sticks and knives are attacking people. So again, take away one thing: if somebody wants to inflict damage on somebody else, well, they'll find a way to do it. And I just thought it was interesting because the response to this was from the company that makes Swiss Army knives, and the chief executive officer, Carl Eisner, told the Swiss paper's name is Blick, on Monday that the Swiss Army knife will soon be available without a blade due to mounting regulations in European and Asian countries amid a surge in violence. So in order to sell the Swiss Army knife in those countries, they have to make one without a blade. So is it really a knife if you just have a knife with no blade? Of course, it'll have all the other gadgets, right? It'll have the tweezers and the bottle opener and, you know, the other stuff in it. It just won't have a knife blade. And so Swiss Army knives are now going to be made. Not all of them, right? They'll have a version of the Swiss Army knife with no blade in it to comply with all these regulatory requirements. I'm just curious at that point, does somebody just start trying to stab them with those little scissors that come in there, right? The little short scissors, or maybe, you know, scratch them with a bottle opener. Yeah. So, the corkscrew. Oh yeah, the corkscrew. There you go. Yeah, like John Wick. Yes. Swiss Army knives are going to go John Wick on everybody. But you know, this is, again, like I said, we're just kind of reaching the point. Again, and this is kind of like the same thing with the tax conversation a second ago. instead of needing to tax people more, maybe you just spend less, right? And, instead of passing ridiculous laws, maybe focus on the reasons why you're having this accelerated rate in crime. It's we're always trying to treat the symptom, not the problem. Anyway, another story. But I just thought that was interesting. Swiss Army knives with no knife. You've now come full circle. So one of the things that's going on right now that is going to be worth paying attention to over the next quarter or two is this what's called residual seasonality. And there's some things that are going on with some of the economic data at the moment, right? So we wrote about over the weekend about the issue of stagflation, and that we had this very strong first quarter uptick in things like PCE, inflation index, the ECI. And we were kind of warning that there's a bit of an anomaly to that data and not to read too much into that data just yet. And of course, everybody immediately went off, it's stagflation. And we went through why it's not yesterday. But there is this issue with government data. And we have all these what's called seasonal adjustments that we do to data. And this data gets skewed, these seasonal adjustments, because of things that happen in the economy. Those seasonal adjustments are just mathematical calculations. They say this has always happened before. And so we have this mathematical formula. When the data comes in January, we're going to apply this mathematical formula to it. We get this adjustment. And there are times that data becomes very skewed because of that. And then we have a catch-up period where that data works itself out over the next few quarters. That is likely going to be something that we see this year. This residual seasonality. It was a small observed factor from 2010 to 2019 and has now emerged as quite a large one. And to really kind of quantify the impact, Morgan Stanley did some work on this, and they compared the average annualized numbers for a quarter to the 4-year quarter average. And for the preceding last 2 years, core PCE prices, this is what I was talking about, the inflation numbers that mean a lot to the Fed in terms of cutting interest rates and that type of thing. And again, got everybody all excited about stagflation. There was a 1.32 percentage point boost to the first quarter numbers that erodes for the rest of the year. And that residual seasonality is shown up elsewhere. It's in the employment cost index, the ECI, which we just talked about as well. It's also in unit labor cost data, as well as in the productivity numbers. And so we see this residual seasonality that's now got to be reversed over the course of the next several quarters. And this is one of the reasons why the Fed has not been overly concerned about inflation. A lot of people are like, oh my gosh, they need to hike rates. And the Fed's like, no, we're not going to hike rates, because they're aware of this already. So as Morgan Stanley states, when so many price metrics display residual seasonality and show a similar pattern of its strengthening, investors would be forgiven for gaining confidence that a pattern will continue into the coming year. However, even if the economy is doing as well as it says, we could still see a very significant fall in inflation data coming up over the course of the next few months. And again, that's kind of what the expectation is. And the Fed is talking about this, potentially needing to cut rates at least once this year, if not more. And they really haven't backed off of that data too much. And a lot of it has to do with this residual seasonality that is going to come through the data. And again, it's just a function of what happens with these mathematical adjustments. And this is why, if you really kind of, and this is what I was doing in the report on Saturday. So if you haven't read the newsletter yet, go to the website, realinvestmentadvice.com, click on the newsletter link, and read the newsletter. But I go through there and I say, look, if you take this data and smooth it, it tells you that there's no inflation, right? This is a an anomaly that's going on with the data right now, and so that's going to work itself out, and that's what'll happen. So again, we're kind of getting some confirmation of that data, and again, it's just the markets are going to see through this, bond yields are going to see through this ultimately, but again, some things can take a little bit longer than we expect them to happen. So today, we've still got quite a few earnings that are going on right now with companies, but by and large, almost all the S&P has now reported. There's a few companies still hanging out there. NVIDIA, as an example, they're towards the end of May, so it'll be there. They report very late in the quarter. But today we've got Disney, Lyft, Reddit, Match Group, Twilio. TripAdvisor reports today, Rockwell Automation, Ferrari, Crocs, so BP, British Petroleum reports today as well. So we've still got quite a few big companies that are reporting, and so that will certainly have an impact on those share prices. But again, overall, the earnings season has not been terrible. It's not been fantastic. It's about average in terms of reported earnings, and surprise rates were high for the most part, and again, as expected, because we kind of cut estimates going into Q1, so the reporting was pretty much as expected, right? I mean, it was pretty positive. Companies beating estimates by a penny here, a penny there. Had a few misses. Importantly, stocks that did miss were punished pretty brutally. Stocks that beat were rewarded a bit, but not dramatically. There was a few outliers. We saw some companies really jump up there. But overall, it was just kind of a fairly normal earnings season. And again, nothing really, surprising about the data. Again, just, we are recovering in earnings, and that kind of goes along with the recovery in economic growth. And so we're just kind of in that process here. And the markets are responding accordingly. Again, markets are a bit ahead of where the earnings growth is. And I still think that, we're going to that's what I'm saying. I think we're still going to have another correction this year. Earnings expectations are still very high right now. So those earnings expectations need to come down a bit. And again, we'll also have the pre-election kind of jitters as well. So again, if we had another correction, kind of later on this summer, that would certainly kind of help realign the market with kind of current earnings. But again, overall, nothing was really, overly surprising. In terms of economic news, there's not a lot. We've got none today. I mean, there's just no economic news today at all, really. And really this week, we don't have a lot. I mean, University of Michigan consumer sentiment is on Friday, wholesale trade on Thursday, and initial jobless claims. But this is a very light week, economically speaking. Now, once we get into next week, we'll start getting some more economic data kind of worth looking at as we continue to kind of wind up, the earnings season overall. But again, nothing really much to move the markets today. Markets are going to open up a little bit this morning, but not dramatically. So again, kind of look here for a little bit of consolidation, maybe a couple of days where the market doesn't really do much of anything, which would actually be fairly decent. We've had a fairly nice rally off the lows. So a little bit of a respite here would give markets a second to kind of catch up with themselves and then potentially hold support here at the 50. And that would be kind of a good bullish setup here for maybe a little bit move higher as we go into next week. All right, that wraps up the show for today. Have a great day. Be sure to go by the website, get our latest daily commentary. It's on the website now, along with the newsletter. Yesterday's commentary is up already. And then, of course, also like and subscribe to the channel. We appreciate it very much. And see you back here tomorrow with Danny Ratliff. Have a great day.